Today we're going to be talking about how much data is in the world, specifically how it relates to investment opportunities and valuations with Amazon Web Services, Google Cloud, and Microsoft Azure. The IDC estimates that by 2025, world data volume creation will reach 175 zettabytes. It's a staggering number and hard to put into perspective. As they allude to in their report, if you could store all data on DVDs, that stack of DVDs would circle the Earth 222 times. It's an astronomical number. IDC and other third-party estimates also indicate that the number of workloads and amount of data in the public cloud could reach as high as 54% by 2025. So given these numbers, can we reconcile revenue growth projections of the big cloud providers with a bottom-up model using data volume creation each year? Let's take a look at the three ways data can be stored and processed. Number one is on local devices. Data can be stored on a local machine, and depending on what type of data this is, that device could be a phone, a laptop, an assembly line robot, a car, a refrigerator, etc. Really anything that has a computer chip in it and can store data or process data or even transmit the data elsewhere. Number two is company-managed data centers. Enterprises will build and manage their own data centers, and depending on the size and industry of the company, these can be massive. Visa and Facebook's data centers are just two examples of the massive scale that these can reach. And number three is cloud computing, or the public cloud. AWS, Azure, and GCP lead the cloud computing market, which is effectively an abstraction of running your own data center. This solves problems of capital costs, time to value, scalability, maintenance, redundancy, and offers a number of additional benefits, all outlined in the article linked in the show notes below. So all of these benefits are important to keep in mind as to why enterprises continue to shift their compute and data storage workloads into the cloud, and they offer validity to many of the assumptions below that we'll go into. Let's dive into the model. Listed on the side here are all of the projections and assumptions that we'll use throughout this model, and we'll go through each in greater detail for each step. The first stat we'll look at is how much revenue each of the major cloud providers brings in terms of data storage. To get there, we'll look at how much data is created, how much data is retained, how much of that is actually stored in the public cloud, and then we'll divide by market share and look at the cost of that data that's stored, broken out by cloud storage costs. So data created, this is what IDC analyzed and came up with in terms of 175 zettabytes of data created in 2025, which is about a 27% compound annual growth rate, which gives us these figures here. If we multiply that out, we can get that figure in terabytes, which is a little bit easier to work with, and also just shows the magnitude of how massive a zettabyte actually is. The next variable and assumption is how much of this data is actually retained. So of course, a lot of data is going to be created, but it may not have any value or may be quickly discarded. And so to get this 2%, I actually looked at historical revenue from the cloud providers and then backed into this number to make them fit the revenue projections for each of the cloud providers in years past. And so for 2022, we look at about 2%, and then decreasing that out to about 1.5% in 2027. The next variable is how much of this data is actually stored in the public cloud. So if all data created, how much makes its way to an Amazon, an Oracle, an AWS, a GCP. This is again IDC and some other third-party estimates, but we're estimating about 42% of workloads are in the cloud in 2022, and that number increasing at about an 8% a year rate to about 56% in 2027. Next is cloud market share. This is from third-party research, and it puts other vendors at about 40% of the total, and Amazon as the leader with 32% market share. Next, to get revenue, we need to look at the data storage costs. Each of the major cloud providers is similar in this respect. We're going to take $240 annually per terabyte for hot storage and half of that amount for cold storage. And to get this ratio here of about 3%, we look to get in historical rates and then some just configuration setup variables. So we're going to estimate about 3% of data that's stored in the public cloud is stored for hot storage, the rest in cold storage. Of course, this would vary by workload or application, but some pretty good starting points. So if we multiply all of this together, we get expected public cloud storage revenues across all vendors. And this doesn't take into account any discounts. So we're going to assume a 50% discount rate. This will aggregate anything for enterprise deals, reserved instances, or long-term contracts that any enterprises may sign. which leaves us with the actual cloud data storage revenue. We multiply that out by market share, and this shows that AWS has the potential to bring in about $14 billion in just data storage revenue in 2022, and the rest of the figures and projections on out. This also leads itself to a data egress asset. So if we consider that 10% of this data stored may have future business value, the cost to actually get this out of the cloud, if any company wanted to, that's going to incur egress costs of about $50 per terabyte. So it's just an interesting point to consider that all of this data stored in the cloud is really an asset. Of course, it's not going to be reported, but an asset to these major cloud providers of more than $1 billion in the case of Amazon. And then last, we need to look at the compute revenue. So Amazon has 200 cloud services. The other major cloud providers have a number of services as well. And to get this ratio, which is going to depend a great deal on the type of workload or the application running, but an average workload, just looking at the Snowflake pricing guide and what some of their workloads look like and how they price that out in terms of storage to compute, we come up with a ratio of about 5.5, which we'll keep. And this may grow in the future as more workloads are more computationally expensive in terms of machine learning or training data. So if we multiply the storage revenue times this ratio, we get about 78 billion for 2022 revenues for AWS. And if we sum that up, this model projects out AWS revenue in this case for 92 billion. And we can compare that with just DCF revenue model projections to see how in line is this estimate, and do that for all of the other cloud providers as well. So for AWS, for example, here's what the data model provides, and then here's some DCF estimates, and we can see the variance percent. So under 20% variance across all cloud providers. And this helps us back in and gives just another data point for valuing future cloud revenues. So if we look at Amazon, for example, they have a number of other segments, of course, and link below for the full Amazon valuation video in the notes below. But we can see for AWS specifically, here's the growth rates that we're targeting, 30% in 2022, and decreasing as they scale to become larger, but offers one point to compare the revenue associated here with the revenue back from this model, and give some confidence into backing into an AWS valuation, which if we sum the cash flows, discount it all back, and look just at the AWS segment, we come up with about an average per share value of $1,400 looking at 2026 values, which gives an implied value of just the AWS segment of about $750 billion, which is close to half of their market capitalization right now. This model offers one more point of validation to the 20 to 35% anticipated year-over-year growth that the major cloud providers could see over the next 5 years. And it lends credibility to the stock price valuations, both current and future, for these major cloud providers. Please let me know if you have any thoughts on all of this, and if you enjoy this type of content, please like and subscribe below. As always, thanks for watching.